we're talking about what we can expect from the union budget next week and how you should prepare your portfolio and your investments for that change. Now, joining me in the studio are the gentlemen who are helping us answer all of those questions, and of course, Dhirendra Kumar in our Delhi office. Vishal, I want to start very quickly with you. We know that the market has been looking at domestic factors of late. We've been looking at the UP elections. We saw the market react to that. The next thing that we're looking at is the union budget and then possibly the RBI policy. What sort of a reaction do you expect from the market on budget day, given what you're expecting from the finance minister?
I think firstly, the budget month tends to be a volatile month because I think there's a whole host of sort of expectations and speculation, and everything gets built in, and there's a lot of trading activity typically before and after typically the budget day. So clearly one should expect volatility. That's not going to go away. The election results obviously adds to that, and then expectations from there adds to that. So I think it's going to be a month of a lot of volatility and therefore opportunity to traders, but caution for long-term investors because you can get it wrong and you don't want to be on the wrong side over the long term. So what I would want viewers to do is tread the month carefully. Unless you're a trader and you're really into it, look out for volatility and manage volatility.
Right. So, Dhirendra, we've talked about this in the past. We've talked about this on previous budget announcements as well. For a long-term investor with an equity portfolio, be it direct equity or mutual funds, should they be reacting to an event like the union budget at all?
No, if you have actually any plan on which you are, executing, and you are on course, and you have it with deep understanding of what your long-term goals are, what your short-term goals are, and that is how your money is aligned, then I think your plan should be budget-proof because, we can have a nasty budget, we can have an outstanding budget, and you should not, and a good plan should make sure that, should ensure that you don't have to do anything about it.
All right, so you don't have to worry if you've made a plan. But Vishal, would you say it's wise if I have some money stashed aside that I can put into my equity portfolio on Friday when that budget is being announced, if the market reacts adversely, that I quickly put in some money, pick up some equity that I can add to my long-term portfolio on strong stocks or on a strong equity diversified fund?
You could do that, but it's always open to a lot of risk because you don't know what's going to happen on the Monday following or the Tuesday following, etc. So you don't really know the direction necessarily on budget day because, as it often happens, with every announcement, the market takes the first sort of input in and reacts. But the longer-term sort of consequences of the full budget gets discussed and sort of assimilated only over the next couple of hours. So I don't think it's necessarily a wise idea to invest on that day. If you want to trade, it's as good as any other day. It's going to have more volatility. But I think what you must do is look at your portfolio post-budget after everything's settled to see, is this the best from a taxation standpoint, or are there changes or tweaks that you want to make? For example, move from dividend to growth, or move from one asset class to the other, depending on what the announcements are.
Do you expect government borrowing to increase over the next year, given where we see the fiscal deficit right now?
Right. So as of now, I don't think he has too much maneuverability, as I said. So I don't know how he's going to ensure that the fiscal deficit is controlled. Either he will have a high fiscal deficit, or he'll have to somehow bring expenses under control. The third possibility, and which I think is what he should tap really well, because that's something that helps in every which way, is how to give a fillip to investments. So for example, if we say that we need $1 trillion of investment in infrastructure, and we, as you were saying, 1 lakh to 3 lakh, if he can come up with a way in which household savings can be channelized more into financial assets than physical assets, then really he can probably ensure that private savings get channelized into infrastructure, there's a fillip to investments, and the whole economy can probably come back on the growth path.
Dhirendra, I want to bring you in here. If we are talking about, like Pranav mentioned, bringing household savings into investments in possibly areas like infrastructure, do you think there'll be something there for debt investors, like we saw infrastructure bonds that did so well over the last year? Do you think the finance minister is going to possibly extend infrastructure bonds for another year, do more to get household savings moved into these sectors?
Yes, that is something which is a possibility. Because that particular component is, proving to be a huge catalyst to the infrastructure project and financing. But I find that there is a fundamental disconnect between the principles of DTC and the way this new exemption has come for the infrastructure bonds. And investors need a roadmap. Investors need a premise whereby you plan for something and that is likely to prevail in coming years.
Vishal, this is true. We've dealt with this for so long now. Investors making decisions at the end of every taxation year, where do I make a 20-year commitment to a ULIP if I don't know what the tax treatment of that product is going to be in 3 years' time? Do I make a commitment of 3 years to an ELSS, 5 years? We talk about these long-term SIP type of moves. If I don't know when the DTC is going to come in and I don't know how the DTC is going to treat this product. So do you, in your interaction with your customers and with investors, have you noticed a certain amount of frustration there? Do you think it's time that the government took heed of the fact that it's actually affecting the decisions we make?
And I think, the short answer would be yes. Having a more stable roadmap sort of an approach does help investor sentiment. So I'm more assured about, the steps I'm taking if I'm planning for 5, 10, 15 years. If by and large I believe that what I'm putting in place is not going to be needing surgery every year or so because of changes in the underlying sort of assumptions. Having said that, tax changes every few years, etc., is a way of life. And I think we've got to understand that, the underlying decisions may not have been necessarily very, very different. So your asset class are by and large broadly going to be similar. Yes, something will get tax advantaged or disadvantaged based on some treatment. So that's why we would think that rebalancing is a good idea. Reviewing, making sure that it still works is a good idea. But it's not necessary to really, sort of get into surgery every year. If we do believe this year that, let's say, growth is going to be top of the agenda, which is what Pranav was talking about, and we do hope that, that overtakes everything else. And therefore, we've heard from the RBI, the concept about maybe interest rate hikes getting topped out and therefore maybe reduction in rates because you want to help, the corporate sector and get growth back.
When do you expect that first reduction to come in now?
Growth is the agenda that overtakes everything. And you do have a bias towards softer interest rates over the later half of this year. Then, that throws up an opportunity for investors in debt. And that is maybe something that you want to take advantage of.
Virendra, I want to bring you in here now, given everything we've talked about so far, because we have ELSS, thankfully, for one more year, because we know that we need to start maybe new pension scheme accounts at this point to prepare for the DTC. Vishal just talked about getting into a long-term debt fund. What would be your investment advice to the viewers right now, given the changes that we might see come from the budget?
There is a great possibility that the whole thing gets tilted to either fixed income or something which is retirement oriented, which is the key provision or the key direction of the DTC, and which I think is quite alarming in a sense that there will be investors have been used to making tax sheltered investment or investment which gets tax break and which gets either recycled or for some postponed consumption but not necessarily pension. So which I think investors have to reconfigure their thinking, and because all future long-term savings which will yield tax advantage will be retirement oriented, which investors have not been used to, and senior citizens, they really have to worry about it because we know that the kind of the way we are culturally configured, investors, senior citizens, they invest. They don't have substantial, current earnings. They derive all their earnings from their investment. Still, they make their tax-saving investment and they're able to recycle it over a period of time, and that ensures their liquidity. There is absolutely no provision of any tax-saving investment for them.